If you think the economy is stable right now, you're about to learn something unsettling. For 150-plus years, a hidden mathematical cycle has predicted every major economic crisis, including 1873, 1929, and 2008. This is not speculation, but a proven pattern traced in official records, discovered by a man powerful governments feared enough to silence. And now, this same unbroken pattern is converging on a single year, 2026. What if the warning signs for the next crisis were already here, ignored by nearly everyone, except those who know how to see them? The answer will challenge everything you believe is safe about the years ahead. In the early 20th century, Russian economist Nikolai Kondratieff set out to answer a deceptively simple question: do economies move in predictable, long-term rhythms? He found his answer not in theory, but in the data, dozens of years of prices, interest rates, industrial output, and commodity cycles. What emerged was a pattern stretching across generations, a recurring wave lasting between 40 and 60 years. Kondratieff described it as a kind of economic climate with 4 distinct seasons. Spring brings recovery and innovation after crisis. Summer is marked by prosperity, rising wages, and optimism. Autumn arrives with slowing growth, rising inflation, and speculation. Then comes winter, a period of deep contraction, when debts become unpayable and markets unravel. These cycles are not just abstract models. They are measured in the records of factories, farms, and financial markets, repeating with a regularity that defies coincidence. This framework, grounded in hard numbers, gives us the vocabulary to recognize where we are and what may come next. Nikolai Kondratieff's discovery did not bring him accolades or safety. In the Soviet Union of the 1930s, any idea that economic crises followed natural, recurring cycles was seen as dangerous heresy. Stalin's regime insisted that the right policies could control the future, and that capitalism's collapse was inevitable. Kondratieff's charts and tables told a different story, one shaped by evidence, not ideology. In 1930, secret police arrived at his office. He was arrested, interrogated, and sentenced to the Gulag. Letters from colleagues describe how he defended his methods, insisting that the data spoke for itself. Even as the political winds turned harsher, he refused to recant. In 1938, Soviet authorities executed him after a closed trial. His work was buried, but not erased. Decades later, declassified Soviet archives confirmed the extent of his persecution. Today, the cycles he identified continue to echo through global markets, outlasting the system that tried to silence him. Each phase of the Kondratieff cycle finds its reflection in the record of modern economies. The post-war 1950s stand as the classic spring, a time of rebuilding when debt burdens were low and new technologies such as television, jet engines, and antibiotics spread rapidly. The 1960s brought summer's heat, with surging job growth, rising wages, and a mood of broad optimism. Factories ran at capacity, home ownership soared, and markets climbed steadily higher. By the 1970s and early 1980s, the cycle had entered autumn. Growth slowed, inflation ran high, and interest rates reached levels not seen before or since. The late 1970s saw speculative frenzies in gold, oil, and real estate, even as everyday costs outpaced paychecks. Then came winter. The Great Depression remains the most vivid example, when debts became impossible to service, unemployment soared, and markets collapsed. Each of these eras, recovery, boom, plateau, and contraction, maps directly onto the 4 seasons Kondratieff described. The pattern is not theoretical. It is written in the ledgers of banks, the minutes of central banks, and the headlines of every major economic era. In September 2008, the world's largest financial institutions teetered on the edge of collapse. Within weeks, the U.S. Congress passed the Troubled Asset Relief Program, TARP, authorizing up to $700 billion to inject capital directly into banks and to buy toxic assets. By the end of 2008, the Treasury had deployed hundreds of billions of dollars, providing lifelines to banks, insurers, and automakers. The Federal Reserve followed with a new playbook, quantitative easing. In November 2008, the Fed began purchasing $600 billion in mortgage-backed securities, later expanding to over $1.7 trillion in bonds. These programs flooded markets with liquidity, driving down borrowing costs and propping up asset prices. Interest rates fell to near zero in December 2008 and remained there for 7 years. For households, businesses, and governments, refinancing became cheaper than ever. Defaults slowed. The immediate threat of a global depression faded. But the underlying debts were not cleared. They were rolled over, extended, and multiplied. This emergency toolkit, TARP, quantitative easing, and zero interest rates, blocked the full force of the economic purge that would have followed. Instead of a deep winter, the crisis was postponed, not eliminated. Central banks and treasuries around the world mirrored these actions, ensuring that no major institution would fail for lack of cash. The cycle's natural clearing mechanism was suspended, replaced by a policy shield of historic scale. What followed was an era where all asset classes began to inflate in tandem, setting the stage for a synchronized bubble with no precedent in modern history. From 2009 through 2021, something unprecedented took hold in global markets. Instead of the usual cycles, where one asset rises as another falls, nearly every major asset class inflated together. Stock indices reached all-time highs, driven by a flood of cheap money and relentless optimism. Bond prices soared as central banks bought trillions of dollars in government and mortgage securities, pushing yields to historic lows. Residential and commercial real estate prices climbed in cities from New York to Shanghai, even as incomes lagged behind. Cryptocurrencies, once a fringe experiment, exploded in value, with Bitcoin rising from under $1,000 in 2016 to over $60,000 at its peak in 2021. Collectibles, fine art, luxury watches, even trading cards set new records at auction houses and online platforms. This was the era of the so-called everything bubble. Unlike past booms, where money moved from stocks to bonds or from property to gold, this time, all asset classes inflated at once. Global price series show a near unbroken upward march across equities, bonds, real estate, and alternative assets. Market strategists and central bankers began to warn, often quietly, that the old rules of diversification no longer applied. When every asset is propped up by the same forces, ultra-low rates, quantitative easing, and persistent stimulus, there is nowhere to hide when those forces reverse. The synchronized surge erased traditional safe havens. Investors searching for stability found that risk had become systemic, not isolated. The markets themselves became a barometer for this fragility, with volatility suppressed and warning signs muted. By 2021, the everything bubble had reached a scale with no modern precedent, setting up a world where the next downturn would not be confined to a single sector, but would ripple across the entire financial system. 3 separate timelines, each grounded in its own data and logic, now stack atop one another, compressing decades of economic history into a single, narrowing window. The result is a clear convergence in the numbers. The first timeline is the Kondratieff Wave, a long arc of expansion and contraction measured in commodity prices, interest rates, and industrial output. The last major peak shows up in the records of the late 1960s and 1970s. Add 50 to 60 years, and the clock points squarely into the 2020s, with the highest probability centered on 2026. The Kondratieff pattern is a long, repeating rhythm that matters because it is rooted in data. Overlaying that is the debt supercycle, a rhythm that stretches even longer. The last saturation point played out in the 1930s, when excessive debt forced economies into wrenching contraction. Add 70 to 80 years, and the next crest appears across the years from 2010 through the 2020s, a period already defined by record borrowing, both public and private. Economists track this cycle with debt to GDP ratios and credit growth rates, and those indicators also converge in the middle of this decade. A third pattern comes from generational studies, tracing the rise and fall of collective memory. Every 80 to 90 years, societies lose the living connection to past crises. The last great upheaval, the Great Depression and World War II, peaked between 1929 and 1933. That timeline brings the next generational reckoning to the years between 2019 and 2023, with aftershocks extending toward 2026. This is a generational pulse that changes how societies respond to risk. When these three cycles are plotted together, each based on separate data sets and methodologies, their transition bands overlap with striking precision. Statistical models show a central peak in the probability curve for systemic crisis in 2026, with a broader window stretching from 2022 to 2027. Monte Carlo simulations suggest a greater than 75% chance that at least two cycles would intersect within a 4-year span, and nearly a 50% chance that all three would align. This is not a single deterministic date, it is a high confidence zone. The consequence is simple and stark. For the first time in more than a century, the major cycles of economic history, debt accumulation, and generational change are all pointing to the same narrow window. That means the risk of crisis is not just elevated, it is statistically concentrated. The convergence is visible in the data, not just in theory, and it creates a period where the chance of systemic disruption becomes materially higher. 5 leading signals now track the approach of the next crisis with a precision that leaves little room for doubt. Each indicator draws from decades of market history, showing how stress builds and spreads well before headlines catch up. The first warning came in 2022, when the U.S. Treasury yield curve inverted. For months, 2-year government bonds yielded more than 10-year bonds. That pattern has preceded every American recession since the 1950s. The inversion quietly reversed in 2024, but the danger lingers. On average, a recession follows within 6 to 18 months after the curve normalizes. The clock started ticking as soon as the curve righted itself, placing the highest risk squarely in late 2025 and into 2026. Corporate credit spreads offer a second signal. In late 2023, the gap between what the safest companies pay to borrow and what riskier firms pay began to widen. By October 2024, high-yield spreads had jumped to over 500 basis points, a level seen before past downturns. Historically, this kind of spread expansion foreshadows crisis within a year or two. Credit markets become less willing to lend, and weaker firms face refinancing at punishing rates. The third measure is money velocity, the speed at which money circulates through the economy. After peaking in early 2022, velocity has slowed, reflecting a shift from spending and investment toward holding cash. In previous cycles, a sustained decline in velocity has signaled trouble ahead, with recessions often arriving 2 to 3 years later. The timeline points to 2025 and 2026 as periods of mounting risk. Consumer debt service ratios provide a fourth signal. By mid-2024, households were spending a larger share of their income on debt payments than at any point since before the global financial crisis. As rates remain elevated, the burden grows heavier, and banks report rising delinquencies. The pattern matches past episodes where consumer stress built for a year or two before tipping into broader contraction. Debt stress is already visible. Commercial real estate forms the final piece. Over $1.5 trillion in U.S. commercial mortgages are set to mature by the end of 2026. Many of these loans were issued when rates were far lower. Now property owners face a refinancing cliff, with payments set to double or triple for those unable to repay in full. Industry panels warn that defaults and forced sales could accelerate as the maturity wall hits in 2025 and 2026. Each of these signals, on its own, might be dismissed as a passing concern. Taken together, they form a chain of evidence, a sequence that in past cycles has ended not in a soft landing, but in systemic stress. The lags built into each indicator compress the window of risk, converging on the very years that the long cycles highlight. The story is not of a single trigger, but of mounting pressure across credit, consumer, and real estate markets, all moving toward a tipping point that statistical models place squarely in the 2025 to 2026 period. Global debt reached an unprecedented level in 2024. Total borrowing worldwide climbed to nearly 336% of global GDP, a figure that includes governments, households, and corporations. For perspective, the world owed about $315 trillion, more than 3 times the value of all goods and services produced in a year. Public debt alone stood at $97 trillion, with countries like the United States and Japan carrying debt loads that far exceed their annual economic output. Private debt also soared, especially in advanced economies, where corporate and household liabilities now approach 270% of GDP. This mountain of leverage has created a new kind of fragility. An estimated 12 to 20% of major listed companies in advanced economies can no longer cover their interest expenses from profits. These so-called zombie firms, kept alive by years of easy money, now account for up to 16% of all corporate debt in the US and Europe. Central banks face a dilemma with no easy exit. Keeping interest rates high means many governments, companies, and households cannot service their debts. Cutting rates risks reigniting inflation and undermining trust in money itself. Policy tools that once bought time now box authorities in, leaving the system exposed as pressures build. Systemic crises do not arrive all at once. They unfold in a sequence that has played out before, each phase setting the stage for the next. The timeline begins with fracture, a sharp event that exposes hidden weaknesses. This could be a major bank failure, a sudden wave of commercial real estate defaults, or a credit market freeze. Most probability models place this initial break in late 2025 or early 2026, based on the lag between today's warning signals and past crises. Once the fracture occurs, panic spreads quickly through financial markets. Credit dries up as trust evaporates. Businesses and households rush to secure cash, while lenders pull back. This is the spread phase, when even healthy firms can be dragged down by tightening liquidity. Authorities then intervene. Central banks cut rates, governments announce emergency programs, and liquidity is injected to restore confidence. Sometimes these measures bring a brief calm, but if underlying debts are too large or confidence too badly shaken, a secondary collapse can follow. In that secondary phase, markets sell off again, defaults mount, and job losses accelerate. Only after this purge does the reset begin, a period when excess debt is cleared, assets are repriced, and the foundation for future growth is rebuilt. This five-phase sequence, anchored by historical evidence, gives a clear framework for what to expect as the cycle turns. Preparation in the face of long-term cycles begins with clear-eyed review, not panic. Lessons from past downturns show that those who reduce leverage before the storm are better positioned to weather it. This means trimming exposure to assets that have run far ahead of underlying value, especially where debt amplifies risk. Review real estate holdings for refinancing needs or potential cash flow strain to help avoid forced sales when credit tightens. Building a cash buffer, enough to cover several months of essential expenses, adds resilience if income is disrupted. Paying down high-interest consumer debt reduces vulnerability because rising rates make servicing loans more expensive during contractions. Diversify savings into assets less tied to speculative bubbles, and keep some funds in liquid form to provide options when markets become illiquid. Beyond finances, history rewards those who study past crises and prepare mentally for volatility. Understand that cycles are part of the system, not an aberration, and that perspective helps when fear dominates headlines. Rational, measured steps now can make the difference between hardship and opportunity when the cycle eventually turns. Today, global debt sits at a record $315 trillion, an unprecedented weight pressing on every sector. As the clock moves toward 2026, history's patterns are not just abstract, they are embedded in our policies, markets, and daily lives. The difference now is foresight. In a world shaped by cycles, those who recognize the storm early decide what survives when it passes.